All right, we're here today with Chuck Wiebe of BIA Capital, and we're very excited to have Chuck as our guest today to talk with business owners more about capital raise. And Chuck, if you would start out by just telling us a little bit more about yourself and BIA and what you do there.
Great. So thanks very much, Joy. I look forward to the conversation. BIA Capital Strategies is a registered broker-dealer. We provide investment banking services to primarily privately held companies, and these can be companies that are started by a group of individuals or a sole proprietor. It could be a private equity sponsored company, or it could be a family-owned company that's through multiple generations of ownership. We were founded to extend the client services that were being offered at the time by our research and consulting affiliate, BIA Kelsey. They had established a really strong foothold in terms of information that they were mining for a lot of different purposes. And it established relationships among investors, lenders, lawyers, accountants, regulators, and a wide range and number of communications-focused companies. And so we were able to build on that experience and bring a transaction advisory element to it. We've been also focused on investing as an SBIC through two separate private equity funds. We've been focused on mezzanine investing. Our industry focus has traditionally been communications and media, but it continues to broaden as a number of different industries are converging or being transformed. We advise companies on strategies for growth, for how to sell their company and how to buy others. You may have known that we've been in partnership with NEF Capital now for a number of months. The firms have known each other for many years and have a deep respect for what NEF Capital has done, and particularly in the fiber arena, data center arena, managed service provider space. And we work together on fundraisers where we can bring some of our expertise and our credibility as a broker-dealer to the table, together with their industry expertise in areas that we may not have as deep domain expertise as they do. So it's been a great partnership to date.
Chuck, that sounds great. And thank you for that overview. And obviously, you have a very deep background and expertise, particularly in the areas where NEF Capital Advisors tends to deal with companies. And, as to your point, certain industries are emerging, data centers, MSPs, cloud providers, having that, resource who can help them understand whether they need capital, if they need capital, then how much. That's going to be pretty important, would you say?
Absolutely.
Okay, so in terms of just this moment in time, how favorable is it to raise capital, and what are you seeing in the market?
It's a fascinating time, I think, to be in the market. It's very dynamic, and yet at the same time, it's been extraordinarily disruptive to a lot of traditional business models that we've seen in this space. Because of advances in software compression and software collaboration tools, combined with having everyone basically having ubiquitous broadband connectivity, there have been any number of different advances that have been made that have been extraordinarily disruptive to business models as a result of the internet. That being said, it has also led to the creation of a number of new capital providers, both on the debt side and the equity side. So it's a fairly crowded space. And we see that evidenced by what I would consider to be a very hot market, very competitive market, that is focused on companies that have EBITDA or operating income well in excess of $5 million. There you've got a number of providers, all of whom are very knowledgeable, have the ability to provide any number of very customized financing solutions for companies, and have a clear and exacting delineation of risk-adjusted return. At the lower end of the market, for companies, let's say, below that $5 million EBITDA threshold, there are fewer lenders and investors who are active, and they also don't tend to have the level of expertise and sophistication of those lenders and investors who are operating at a slightly higher market, just have not had the time to dedicate to a specialized industry segment similar to the one that NEF Capital and BIA are focused on. So I think it's a little bit more challenging for those companies that are, quote, subscale, fewer capital providers, and they really need to provide a higher level of education for either a lender or investor who's interested in the business, and need help in establishing a valuation for their business that doesn't just get perceived as a more risky business because it is subscale. I don't think the two are necessarily correlated. So I would say it's a great time to be in the market, but it's very important to see where you are in terms of size and also business model. There are any number of business models right now that are either what we refer to as capital light. They don't require a lot in the way of capital expenditures, or those businesses similar to a data center, similar to managed service provider, which tend to be a little bit more capital heavy. Although the revenues that are generated tend to be more predictable and recurring over a multi-year period.
What major differences exist in the size of the company? Is it the length of time of the process? Is it the pool of investors available and lenders available? What do you see as the biggest differences between what we've called small businesses versus larger businesses?
I guess the biggest one, and it directly is correlated to perception of risk, is if you've been a company that is able to consistently over time generate a level of revenue and a level of cash flow, the perceived risk is much lower than for a company that is either growing very quickly or growing erratically and has not really established itself in the market. And one measure of that is going to be the size of your revenue base. And so if you are, and it all depends on the business, because some businesses, the tower business as an example, will have very low revenue, very high cash flow, and tremendous value that so far outstrips what you might perceive from the revenue and the cash flow. Other businesses, have very thin margins, profit margins, and therefore, if you say I'm a $100 million business, well, if you're only kind of 3%, profit margin, it's not that value. I mean, the 100 million overstates, I think, the true value of that business and sustainability of that business over time. I mean, ultimately, it comes down to how profitable are you in terms of squeezing out dollars for every dollar of revenue that you generate. So I think it's just a question of investors and lenders think if you've got $5 million of EBITDA, you're a pretty well established smaller company and are likely to be around for a while, and it's unlikely that you're going to be hurt, and it's going to take time to hurt you and then deplete that cash flow. If on the other hand, and I just was looking at a company today, if you're a company that say generates $8 million of revenue, but you've yet to cross the $1 million EBITDA threshold and are bouncing between, say, $100,000 of profit and $750,000 of profit, it's not clear that that company is completely out of the woods yet and is going to be a sustainable enterprise over a long period of time. So as a lender, if you're looking to be a term loan lender and have, say, a 3 to 5 year time horizon, that may be too long for a business that's not sustainable for that period of time or could potentially be unsustainable.
Great. So with that in mind, perhaps it's good to take a step back and have a better understanding of the sources of money and the structure of deals at a high level. In particular, I think it would be helpful to offer some insights around the types of deal structures and the potential costs of each one.
Sure, and I think we both recognize it's a pretty, I would say, complicated question, or at least a very nuanced question, because there are lots of different types of capital, all of which have different profiles. But let's keep it really basic. If you were to look to raise capital to finance an acquisition, let's say, the cheapest cost of capital that you could find would be from a senior secured lender. Typically, it could be a commercial bank, it could be another financial services company that provides senior capital, which is secured or by first lien on all the assets and typically stock of the company, and has a cost that might be somewhere in the range of, again, broadly speaking, maybe 5% to 8%. A next layer of capital that might be part of a financing solution could be what we refer to as mezzanine capital. It could be also referred to as second lien capital, which has a higher cost. It might be in sort of the 10 to 13% 15% range. Um, and then below that, you have a variety of different types of equity capital structured any number of different ways, just to reflect whatever the needs of the investor and the needs of the existing shareholders might be. So it could be a preferred strip of equity. It could be a convertible strip of equity or debt, common equity, just a lot of different flavors. And again, that in terms of cost, that tends to be your most expensive cost of capital. Investors are typically seeking a return and is expressed as an IRR percentage in the high teens, low 20s, expressed as a multiple of the capital that they invest. They might be seeking a 2.5 to 4 times return on their initial investment.
As you work with business owners, how do you determine which type of financing is relevant for their business?
Yeah, great question. If I can actually just step back for 1 second, one of the ones I didn't mention that certainly has become prominent is what's referred to as a unitranche facility. And a lot of the financial services companies, to the extent that they have buckets of capital that they can manipulate, slice and dice in any way they want, that have lower and higher degrees of risk, that can all be factored into one single facility with one lender and the borrower, so that credit documentation is fairly straightforward. And I apologize, Joy. Please ask your question one more time. I apologize for stepping back.
No, that makes perfect sense. And really what I'm trying to understand is how, when you meet with a business owner, how do you determine which type of lending solution is right for them?
It could be a lending solution, it could be an investment solution, or it could be some combination of both. It really depends on what the business is trying to accomplish. If they're trying to make an acquisition, if they are really seeking growth capital to potentially add a new product or service to their existing offering, or maybe a technological migration, if they want to build into another geographic location, or in some cases, if they want to buy out a partner. So each of those circumstances has a different type of financial profile or financing profile to it. I think it really depends on what's the amount of money that's needed and what type of return can that produce. And from there, you really can start to back into what is an appropriate and market level of debt that we can try to pursue from a lender. What's the appropriate amount of equity, and combine that in terms of what should be the overall cost for the transaction. So there are a lot of different elements that factor into it, but at the end of the day, I think it really comes out to be a little bit of puzzle solving, and also marrying that with what's the market, who are the players in the market that we can approach, and how do we optimize the terms that our client can get.
Great. So once you've met with an owner and determined that they definitely need capital, whether by lending or by investment, or the combination, and what's the next step from there? I think there's a lot of mystery around the process. So I'd love to just, if you could clarify the process a bit more as to, once they've determined they need capital, where do you go from there?
Well, ideally, our firm and the company have hit it off, and we realize that we can work effectively together to really accomplish the solution or the objective that the company's laid out in front of it in terms of raising capital. We always will sign an engagement agreement with our clients that spells out the terms and conditions of our work together, including scope of services, time periods, compensation, and other extraneous matters that really govern the relationship between client and BIA Capital Strategies and NEF Capital. From there, it's a fairly standard process, if you were to lay it out, whereby we try to again confirm what are the strategic objectives the company's trying to accomplish, the management group, the shareholder group, and all the different internal constituents. And based on that, what are the consequences or the repercussions of the financing that they're going to undertake? What will be the change in the financial profile of the company? So we do extensive financial modeling with the company to determine what the company has looked like previously. And as a result of this new capital infusion, what will the company look like on a go-forward basis, and we model that very carefully. One of the key elements is to help establish a bridge between where the company is today and where it's going, and really lay out in excruciating detail what are the assumptions governing that change in financial profile of the company. We identify, and again, many of these are going to be happening concurrently. We're identifying target lists for investors and or lenders. We are preparing documentation together with the company in terms of a marketing piece, a confidential information memorandum, or a particular PowerPoint presentation or deck. We are establishing, again, with the help of the company, a data room that we populate with all relevant information that could be helpful for an interested lender or investor. And then we are going out to market and beginning the process of bringing investors and lenders to the table, piquing their interest in the company and what they're trying to accomplish, and trying to marry up the appropriate lender investor to accomplish that goal. So again, just a broad brush. I mean, what we've really noticed in doing this for a number of years is while we can lay that out and we can establish timelines for each of those different phases, frequently you just come up with obstacles or deal hurdles that come in the way that need to be overcome. You might find that you don't have the type of information that you want to present to an investor in the way you want to present it, and you need to rework that. It may be that you need other pieces of financial analysis. It may be that you need to have much more information about the industry and competitors in the industry. Whatever it is, those get factored into the process.
So let's dig a little bit deeper into specifically what is looking attractive to these investors and lenders as they're looking at how to spend their capital.
Yeah, if you had a checklist, you'd certainly want to include a very solid balance sheet and a strong position, both cash and liquidity. You'd want to know that your revenue, your top line is growing. Your profit margin is continuing to expand with additional revenue growth as opposed to contract. That the business itself generates strong cash flow, and this is cash flow after accounting for any type of financing that you've done, as well as capital expenditures that you need to make, both on a maintenance level as well as a growth level. And then you've got a strong management team that has both ambitious objectives, but is also realistic enough to have mapped out a plan to realize those ambitious objectives. So again, those are the magical boxes that you'd love to check. It doesn't always happen that way. In fact, rarely does. And there are going to be some boxes that you can't check, and therefore you factor that into your calculation of risk in the transaction. But clearly, strong management, you hear that all the time. That's key, and it's a management team that is very aware of its strengths and weaknesses. Is not afraid of acknowledging weakness, evidencing weakness, because it's just part of doing business. No business is going to be perfect and can have all the boxes checked. So really, at the end of the day, an investor wants to see that there's going to be a really good chance of getting a return on their investment that they had bargained for based on the information and the way that the company is presented to them, that will create additional equity value. And in the case of a loan, they want the confidence that that loan will be repaid, and that loan will be repaid on time.
Well, thank you so much, Chuck. This has been extremely insightful, both on an educational level to just demystify the process a bit, as well as discuss some of the different lending and investment types and the costs of each. And I just really appreciate the time.
Well, we really appreciate the opportunity to speak with you, and it's something obviously we feel we continue to be excited by. I would love to be in the transaction business, and really more than anything, love to be in the advisory business. I mean, this is working with companies, helping to educate each other about their business and ours, and ideally finding some opportunities that are really going to be transformative for those companies.
Wonderful. Well, thanks again, Chuck, and we look forward to the next webcast.